Hello, everybody, and welcome to the latest episode of the Daffernomics podcast, brought to you by Dafferns, an independent accounting firm based in Coventry in Warwickshire with national and international connections. My name's Martin Gibbs, and I'm joined today by two of the Dafferns partners, Brian Jukes
Hello there.
and Mark Brayshaw.
Morning, everybody.
Yesterday, we're recording this on Thursday, the 27th of November. This is early morning on the Thursday. So we've had a little bit of time to absorb what happened with the budget yesterday lunchtime. Brian, sort of your headline take, how would you summarize the budget?
Oh, an incredibly political budget, which always irritates me no end. I found myself more irritated than ever, and I've sat through an awful lot of budgets, so that's saying something. Um, it was a tax and spend budget, which we were anticipating to some degree, although
Yep.
perhaps not as much spending as there was. And maybe that means there's more headroom than we thought, which is good news, but too much politicking,
Yep.
too much nodding to the Labour backbenchers.
George Osborne on the Political Currency podcast described it as a budget for benefits that benefit the few, paid for by working people. I may be paraphrasing him slightly there.
Yeah, I
But
think that's
Mark, before
absolutely
the
true.
before the budget started, there was a big hoo-ha.
There certainly was, and we had only last month we had we did a podcast, didn't we, based upon our predictions.
Yep.
And interestingly enough, I think both Brian and I advocated that actually just get it over with, increase income tax.
Yep. Rip the plaster off, you said.
Exactly. I think that was the phrase we used. And only a couple of days after that, there was all the media hoo-haing about Rachel Reeves is going to increase income tax by 2%. And we had that pre-budget news conference where the opposition leader referred to it as a waffle bomb of excuses and blame game, etc., etc. So it looked like that was on the cards for a while. And then the Labour Party seemed to backtrack on that. However, given what was discussed yesterday, I would argue that they still did increase the rate of income tax, as we will come to later in certain aspects. But
Rachel Reeves was furious, wasn't she, at the start of her speech with
in so much that the
OBR leak.
They'd accidentally published their report early. Yes, absolutely. Yeah. Similar to us, we've obviously got this speech going at the minute, and we've had ours leaked, haven't we, online on the Dafferns website, all of our blogs. So if you want to get a heads up of what we're going to be discussing over the next few minutes,
wouldn't have happened in my day, Mark. Wouldn't have happened in my days.
Mark, that was deliberate, whereas the OBR was most definitely not.
Yeah.
Yeah.
Well, Madam Deputy Speaker yesterday was really ripping into these leaks. Extensive briefings in advance to an unprecedented level, falling short of the high standards expected, showing disrespect to the House and the parliamentary code.
And to lead on for that, I won't steal Brian's thunder with his new quote, but the chief economist of the Bank of England has been on record to say that this has helped, that's stagnated the economy. All of this uncertainty has just stopped people doing business, stopped their day-to-day activities. I think it's been a bit of a frustrating 2 or 3 months for all involved, personally and professionally. We've had clients contacting us, well, what do you think of this and what do you think of that? And it's like, well, we can't say. There's so much, there were so many leaks, and
it creates uncertainty.
Yeah,
uncertainty and worry and stress. And they're just testing the water,
which is absolutely the absolute opposite of what businesses crave, which is certainty. If you've got that certainty, you can just get on, deal with it. We've shown in the past, I think, as a business community, with what's happened over the last 5 or so years with COVID, Ukraine, the Middle East, Brexit, pretty resilient, to be honest. So let's just get on and do things as best we can.
So about a month ago,
can I just say one thing there?
Sure.
As I alluded to earlier, I've sat through an awful lot of budgets. So I've seen an awful lot of pre-budget speculation over the years. Never in my life have I seen anything like the degree of speculation. And it's not so much the speculation, it's the leaks, the testing of the water that the government seemed to have been deliberately doing. that's created so much uncertainty, so much. The phrase I came up with, talking to my son who's doing A-level economics last night, the phrase I came up with is economic constipation.
Economic constipation. Yeah.
And I really think that talking to solicitors and fellow accountants in the professional world, they've all felt this. They've felt it very, very keenly that businesses have just stopped doing things. Transactions have dried up, and that's no coincidence. That's because of the way the government have carried on themselves during the last 3 months.
So maybe a good point to start on this is a month ago we did the last episode of the podcast, and we were looking ahead to anticipated tax rises in yesterday's budget. So, Mark, should we go back and have a look at a few of our predictions and see where we got them
Yeah.
right, where we got them wrong? So, you've already talked about income tax and your suggestion of just rip the plaster off, forget the manifesto pledge, rip the plaster off, add 2% onto income tax.
Well, they have added 2% onto income tax, albeit only certain types of income.
Yep.
So, for instance, dividend income for basic and higher rates, and also an increase of 2% on savings income and what's the income from property as well. So, but that doesn't take it. The latter two don't take effect until April 2027.
One thing which will be of great interest to many of your clients is going to be what is the optimum mix of salary and dividend for a director shareholder in their own company. And that's going to take a bit of working out now because there's an extra 2% on dividend tax.
Absolutely, and also with the increase in the employment allowance from an NI point of view, it's not as an easy calculation as it once was. There's a lot of factors to throw into the mix depending on the number of directors, number of shareholders, etc., and how you want to adopt that remuneration package. Yeah, ultimately.
And it's always weird, isn't it? Because we have the budget in the autumn now, but the tax tables and tax rates, particularly on Dafferns' website, get published just prior to the end of the tax year. So there's quite a way to go before tax rates are actually fully confirmed. So in terms of working out where the optimum levels for things sit, there's still a little bit of water to go under the bridge before that can be confirmed.
There's plenty of head scratching to be done between now and next April, that's for sure.
Okay. What about fuel duty? We talked about that last time.
We did. I think we said we couldn't really see past the extension of the fuel duty discount of whatever 5 pence per litre. There's been a stay of execution for that. It looks like that's in play until September 2026, where it will revert back to rising with RPI or CPI. So it's a bit of respite for motorists. Nothing to shout home about.
We'll come back to motorists who don't use petrol or diesel a little bit later on. We also a month ago, Mark, we were talking about, well, I mentioned mansions tax, and you were sort of extending that to property taxes. But
yeah, I think that was one of my what I wanted to see. I think it's a fairer way of taxing people, based upon the value of their homes ultimately. And what was announced in the budget is there's going to be a revaluation of all properties in England and Wales with council tax bands of F, G, and H, so the three highest bands. And then they're going to, and the government are also going to implement a mansion tax on properties above £2 million, valued above £2 million, and valued above £5 million. How on earth this is going to work in practice, I don't know. I mean, we're going to have set chartered surveyors out to value properties, or whose responsibility is that going to be? Is it going to be borne on the local council? The individual householders are going to have to do it and declare it, or so it says again. There's a lot of.
It's going to be a minefield. If you look at the way Angela Rayner fell down over property taxes and the complexity of the current system as to how things work, sounds like an absolute minefield with this revaluation exercise.
But I should think land agents will be rubbing their hands with glee.
Yeah.
They'll be busy.
Absolutely. We were very concerned last month about the whole pension scenario, pensions, taxes, tax-free lump sums.
Yeah, we've been speculating. Well, the whole world at large has been speculating about this for years, and every year the budget comes around and not very much changes. Um, there is a change, and it is quite significant to a relatively small part of the population, and that's that the salary sacrifice rules are being tightened. So there's a cap on how much of your salary you can sacrifice and still take the national insurance benefits.
Yeah.
However, that's not coming in until 2029. So there's an awful lot of time to plan, scope to plan, and also I suspect there will be a lot of changes in the way that employers interact with their employees, and indeed employees want to interact with their employers in order to not get around that legislation, but put in place plans which enact what the employee wants to do.
So with salary sacrifice, Mark, when does all this kick in?
So it's from April 29, isn't it?
Yeah,
So
which is a long way away.
so it gives that, which is quite nice in a way, because it gives employers and also employees time to plan. It doesn't look as if potentially employer contributions are covered. This is purely a salary sacrifice issue at the minute. Whether later down, because there is potentially a very easy get out to this, to be honest, in order to preserve the potential tax savings, but whether there'll be any anti-avoidance legislation or any sort of forestalling rules that will be put in place between now and then remains to be seen. But I'd imagine there would be, but
I suspect that this is really targeted at bankers' bonuses and similar, where they're phenomenally large
But this is what
sums.
happens, isn't it? They target something at something big, but it has collateral damage.
Yes.
Dafferns' own payroll. Dafferns do a salary exchange system. I'd say probably from memory, the majority of payrolls that Dafferns run for clients use salary exchange. It's very effective, and so that's going to be impacted from 2029. What is salary sacrifice, salary exchange? It's going to have to be defined a lot closer.
Yeah, that's going to be a really tricky one to legislate.
Yeah.
But at the same time, that they've given themselves 4 years to get that legislation right. I suspect that's not why they've given themselves 4 years. I think they've done that because they want to encourage people to
Yeah.
tuck money away into pension funds between now and then.
Absolutely, because the other way to look at it is you've got 4 years to max out salary sacrifice on pension,
Yeah,
maybe salary sacrifice on EV cars. You've got 4 years to plow into it before the loophole gets closed. So that's another way to look at it. So yeah.
it is.
Okay. A final thing, just going back to predictions, we did talk about VAT thresholds. Currently, the registration limit is 90,000, but we were musing about whether that should come down and get rid of the big step change into VAT. And with making tax digital kicking in for the self-employed, so 30,000 next year and 40,000 the year after, and people having to report quarterly to HMRC through making tax digital, there might have been some logic in bringing the VAT threshold down to the MTD levels and start to simplify the system. That would have raised a huge amount of tax. But luckily, perhaps they've stepped away from it or just ignored it entirely. Maybe they don't listen to the Daffernomics podcast. I don't know.
Well, obviously not. Obviously, they would get some pearls of wisdom if they did. But it's always felt to me as though that VAT threshold has been a handbrake on the economy in this country.
Yeah.
It creates absurd behavior at the margin.
Yeah.
So that's never a good thing.
Yeah.
Do you eliminate it completely? Well, no, because then you'll bring some really small traders in and the admin is just disproportionate. But it surely should be a lower figure than it is. It feels like it should be to me.
Well, maybe if we move on now from our predictions to just a little bit of the detail from yesterday's budget speech. Mark, stealth taxes and tax thresholds.
Well, the old fiscal drag has become a buzz phrase, hasn't it, over the last several years or so? So that's effectively where thresholds of where you pay your your basic rate tax, higher rate tax, and additional rate tax, they don't increase in line with inflation, which ultimately brings more people into those respective tax brackets. There's a lot has been made of this. However, I would just like to revert back. 20 years or so years ago, the personal allowance was in the region of around £4,000, and it's now 12,570. So actually, whilst we're feeling the pain in the near term, in the previous long term, it probably evens itself out actually. So, but still frustrating for a lot of people, because I think estimates predict now 1 in 4 people are going to be dragged into the higher rate band by the end of 2030. Which is a significant tax burden on yourself. Ultimately, you're going to be paying 40. Those individuals will be paying 40% tax plus 2% national insurance. So 42% effective rate. And then if you've got a student loan, which a lot of people will have, there's a potential additional tax burden there of say 9%. So over half your additional income is going to be taxed. And then ultimately, once you get to £60,000 potentially, and if you've got children, then your child benefit, your high income child benefit charge kicks in. So and £60,000 isn't a phenomenal amount of money to earn nowadays. Don't get me wrong, it's you could be in a lot worse position, but it's not. It's not beyond the realms of an awful lot of people to earn that because with minimum wage, I think if you earn minimum wage, you're going to get paid about £25,000 a year for context.
I mean, there's a real point there. Minimum wage has gone up, and I think based on 37.5 hours a week, it's just under 25,000, 24,700 and something. So, most employers, you would have thought, are going to round that up to 25,000, on top of which you've got employer pension contributions, and you've got employers' national insurance, which I don't know is probably going to be the thick end of another 20% on top. So that's the thick end of £30,000 to employ a new starter, 21-year-old with no experience.
Someone who collects trolleys in Tesco's, for instance. That's a lot of money, isn't it?
Yeah.
Just a point going back to the freezes of rates and thresholds. It's worth noting that is by far and away the biggest revenue raiser within this budget. If you see a graph or a histogram of the revenue raising measures, that one stands out by a country mile.
So, Mark, how much did the Chancellor think that she raised from last year's budget?
Economists predicted it was about a £40 billion tax raising budget, and of course we had the afterwards the media briefings. I promise I'm not going to come back for more. Not going to come back for more. And estimates think around a further 26 billion this budget.
Although, as we were saying earlier, it's where they got that number from. But equally, they've hopefully built up a bit of headroom within.
Hopefully so, because the problem we're in now is we've had this budget yesterday. Great, we've drawn a line in the sand now for 2025. People are still going to be thinking. People have got one eye on 26's budget now, and then 27's as well, because broken promise after broken promise. Unfortunately, what is going to happen?
Stability and consistency just aren't there. I think we've already touched as well on the extra 2% income tax on, as the Chancellor described it, non-earned income. So dividend tax and savings interest.
And
also property income as well.
Property income. Brian, we've got to rip the plaster off on the car front. I know you don't like talking about this, but pay per mile for EVs.
Yeah, it had to happen. I freely admit it had to happen because, of course, if you're moving towards a nation of EV car drivers, then you've got a big black hole that you're losing in terms of the tax you collect on petrol and diesel. So you have to replace that somehow. It didn't have to be necessarily directly on EV drivers. It could have been on all countless things, but there is this direct link, causal link, of course, of driving cars, damaging roads, needing to be able to get from A to B. So it does make sense on a level.
How many miles a year do you do then, Brian, in your EV?
About 11,000.
And at 3p a mile with your maths degree, you'll be able to tell me what that is. Was that 330 quid a year or something? I don't know.
Sounds like it, yeah.
On my big diesel SUV, just renewed the road tax yesterday. That's 620 quid. So 330 sounds like a bargain, Brian.
But I'll still be paying road fund license as well.
Good.
Yeah, I was about to say
Good.
it's on
Yeah.
top of road fund license. So you're looking at 500, aren't you, in total?
Yeah.
Dafferns' office is on Binley Business Park in Coventry. At the top of the road by the roundabout, as you come into the business park, there is a petrol station, as we have formerly called it. But the reality is that is an HMRC tax and duty collecting station, because the huge amount of fuel duty, VAT on fuel duty and on the fuel price as well, the amount of tax that gets collected through the petrol and diesel pump is enormous. We always knew it was going to be a black hole that needed to be filled, and this is just a sensible first step.
I agree, but you do have to keep it proportionate. Otherwise, you won't motivate people to move towards electric cars, which is still the direction of travel at the moment.
Something which is likely to be of interest, Mark, to quite a lot of Dafferns clients looking to come up with interesting ways to exit their business, and the tax changes on employee ownership trusts.
Yes, effective immediately. The relief has been reduced from 100%, a capital gains tax relief from 100% to 50%. So ultimately, when a business owner decides to exit and sell their shares into an employee ownership trust, in the past, it's effectively been a no gain, no loss transfer, and providing certain criteria are met for a certain period of time, then it's effectively tax free. Now, excuse me, from yesterday, that's 50% comes into charge immediately. So it's obviously it's a massive uplift, and that does that encourage the right behaviour? Because the reason the 50% charge has come into play is because it's costing the government 20 times more than anticipated. However, I think it's important to look beyond just the monetary figures, because the reason this was implemented was because an employee ownership trust generally requires a specific fact pattern. The vendors can't sell their business to a third party, or there isn't a strong MBO team in place, or that's not appropriate. So rather than liquidate the company, for instance, as one option, which is what they could do, and put all the employees, make them redundant, the government encouraged this method of the employees actually own it via a trust, and et cetera, and it keeps that company open. And it was a win-win situation. And now only time will tell whether the 50% charge will drive certain bit. I'm quite sure it will. It will drive different behaviour. And then there's the thing is, often employee ownership trust, or the shares disposed of into a trust for little to no immediately cash benefit to the vendor. How is the tax on that, the 50% of that going to work? Because ultimately your disposal will be on the date you dispose of those shares, the crystallize the disposal on the date that those shares are put into that trust. Again, there's a lot of detail that needs to be ironed out on this, but it was effective.
How much is that actually going to raise in tax? I mean,
well, they're predicting 0.9 billion, so 900 million pounds per year by 27, I think. I find that hard to believe, I must admit, because I
which
suspect
is less than Donald Trump's claiming off the BBC. So
yes, indeed. But those figures they're quite eye-watering, because I think there's been an awful lot of EOT, employee ownership trust activity, in recent years that's satisfied a latent demand, and that's now done. And so is there going to be an awful lot more EOT activity in the future? I don't think so. But this has basically made it an awful lot less attractive.
Maybe a final one just to cover here then, Brian. Capital allowances.
The government appear to be raising fairly significant amounts from what seems like a relatively innocuous change to the capital allowances regime. There's a reducing balance of, well, you have to go into a lot of detail to understand this, but
bearing in mind, you guys are accountants, and now I'm retired and technically no longer an accountant, I have discovered not many people aren't interested in the difference between straight line depreciation and reducing balance depreciation.
It's really weird, that, isn't it? I don't understand it, but anyway, you can write off your fixed asset purchases, your capital purchases over a number of years, and the tax regime allowed you to write off 18% per year on a reducing balance basis. That's going down to 14% per year. And apparently that's going to raise about 1.5 billion per year in tax. Um, I suspect this is going to have very little, if any, impact on our clients. This is targeted at large businesses, very large businesses.
So at the moment, full expensing exists.
Yeah.
How does that work?
Well, full expensing allows you to write off in year one for tax purposes your entire cost of purchasing plant and machinery assets. Plant and machinery is another tax concept that you have to dig into very deeply to understand what that really means. But basically, it covers most assets other than property and cars
But it
and a
includes
few other bits.
EVs.
Well, EVs is a separate category in itself. That's got its own legislation. But yeah, full expensing was introduced about 2 years ago, 3 years ago, 2 years ago, I think, and we wondered whether it was going to be temporary. We debated whether it was being removed at this point in time, but apparently not. It is continuing. Mark, am I right in saying that the full
As I understand it, the full expensing is permanent, and
yeah,
I think where we've had the debate over the 40%, first year allowance, full expensing it's important to note it's only available to companies. It's not available to self-employed,
yes,
LLPs, partnerships, sole traders, etc. So that's where the 40% first year allowance comes
Right.
in, and there were certain assets before that weren't eligible, such as leased assets, which will now be eligible for that 40% first year allowance.
But none of this is simple. I mean, here's us
No,
sort of,
not at all. Even for us, we're trawling through all the headlines. We've got to look at all of the backing data, and
yeah.
there's such a raft of information to go through. Yes, exactly.
Already on Dafferns' website, I can see that there's probably 4 or 5 really interesting in-depth blogs on specific points coming out of the budget, and no doubt in coming days there will be more. There'll be a budget mail out for clients coming very soon. That will have a link to this podcast in it, amongst other things. But before we wrap up, Mark, any personal angle that you've got, or anything else you'd like to add?
Yeah, actually, I'm a governor at my children's local primary school, and interestingly, it looks as if the funding for SEND pupils, so that's pupils with special educational needs, is now going to be funded by the government and not by the local authority. So hopefully that's a positive step, because then the government's going to get full oversight of the true nature of the funding issues in place. So a bit of context is primary schools are chronically underfunded at that level. The actual cost it costs to actually educate a child with SEND, is far outweighs the actual income being given by the respective local authorities, etc. So from that point of view, personal point of view, and to develop, our future leaders, our future generations, our future taxpayers, our future people who are going to be paying paying into our state pensions, for instance, I think that's a positive step.
Yeah. And I know you're in big favour of that, Brian, because your wife is a teaching assistant.
absolutely. And she is directly dealing with children with special educational needs, and she's on an almost daily basis coming up against budgetary constraints where the head teacher is saying you can't do that because we just haven't got the budget for it. So this will highlight to the government just how big an issue this is.
Moving forward, then, both of you are more than happy to talk to any client or prospect about the budget, about any tax planning. You're here to help. Huge amount of expertise within the Dafferns tax team. So please check out daffens.com, get in touch with Brian and Mark, and we look forward to seeing you on another podcast at some point, maybe early in the next year. So, Brian
Thank you very much.
and Mark, thank you.
Thank you.